What's up, YouTube? This is the Working Investor. In this video, we are going to talk about taxes. We're going to talk a little bit about Bitcoin. We're going to talk about different strategies that I'm using. And I had a lot of people in the community, in the investing community, that were not sure where in the 1099 tax forms, the return on capital is. So I even reached out to my broker, and I didn't get a clear answer. So I think I figured out the answer. So I wanted to share with you guys and some strategies that I'm doing. Let's get into the video. So the big topics we're going to cover is qualified versus unqualified dividends. I mean, I'm sure a lot of us know about this. I'm just going to review that quickly. We'll talk about tax loss harvesting and the wash sale rule as well. And and also, like I mentioned earlier, ROC, return on capital, aka non-dividend distributions. So looking at the tax form, I had to remove some aspects just for personal reasons, but you see here that they have here, this is the 1099 DIV, the dividend one, a section of the consolidated tax form. And you see here total ordinary dividends, and then you see 11,775.30. And then you see here it says qualified dividends, which is taxed at a better rate, which is 27,1649. So you see that some of my dividends I received is qualified and some of them is unqualified. So what does that mean? So if you go on NerdWallet, you could see here they have a nice article that talks about dividends qualified versus non-qualified dividends. So non-qualified dividends are basically taxed at your tax rate based on the tax brackets that can go up to 37%. And qualified dividends is much more favorable. It could be 0% tax, 15% tax, or sometimes 20% tax. I read an article from the IRS that most people kind of run around the 15% tax rate. And here they have a nice chart in this article where you see the zero. So if somebody's single who has less than $47,000 a year of income, they would be in the 0% tax rate, or married filed jointly up under 94,000 should be in the 0% tax rate if your income as a family is less than 94,000. 15% is where most people fall. So single, somewhere between 47,000 and 518,000. That's only 15% tax rate. And married filed jointly between $94,051 and $583,750. So only for those who are single making more than $518,901, they tend to be in the 20% tax rate for the qualified dividends. And the married filed jointly, pretty much you have to make more than $583,751. So most people are under that. So most people will be according to the IRS, statistically, they see most people are kind of in the 15% tax rate as a family or individually. Now this is for 2024. Now we're in 2025. So they bumped up the single like about $1,000 more. So things are a little higher. So you could see here in 2025, you have to exceed $600,000 as a family, or $533,400 as a single file singly, to be in the 20%. So you could see here that 50% is definitely, for most cases, could be more favorable. Why? Because look at the IRS this is from the IRS.gov, the 2024 tax rates for single filers. So you see here, somebody making $47,000, somebody making under 47,000, but if they made more than 11,000, they would be in the 12% tax rate, right? But if it's considered qualified dividend, they would be 0% on the qualified dividends. And you can see here that, the tax rates keeps going up. It goes up to 37%. So you could see in most circumstances, almost every circumstance, again, all this is not financial advice, not tax advice, and not or legal advice. You have to consult with who you have to consult with. See my disclaimers. I'm just presenting you some articles that I found, and you can go ahead and look into those articles further. And I'm just here to open up the conversation to talk about with your tax preparers and accountants and whatnot. But you see here, these are the tax rates for 2024, according to the IRS.gov. And here you could see for married filed jointly for 2024 tax rates, and a lot of people are mistaken. They think that if you make $95,000, they're going to be taxed 22% on the whole entire $95,000 because they hit the 94,000 threshold. But the truth is that it's from zero till $23,000, that's 10%, right? And then from 23,000 to 94,000, it goes in stages. That portion of your income is 12%. And then from 94,301, to 201.51, that portion is 22. And then once you hit, so on and so forth. Then there's also standard deduction. So you don't pay, and we could talk about standard deduction. So this is an article I found from the IRS.gov. And actually in 2025, this year, the standard deduction is going up. So you could see for single payers and married individuals filing separately, the the standard deduction rises to $15,000. And this is an increase of $400 from 2024. So that means that in 2024, this year that we're filing taxes from the previous year, 2024, it appears that the standard deduction was, 14,600, and then couples filing jointly, it rises to $30,000. So it's an increase of $800. So it looks like it would have been 29,200 in 2024. So this coming year, you get a little more. It goes up, the standard deduction. The standard deduction, what I understand, again, just a retail investor here, is that there's itemized deductions and there's standard deductions, and most people do better with the standard, are more advantageous with the standard, but some people would do better with the itemized. So this is like, for example, in 2025 for a single person filing, it's 15 grand. So the first 15 grand is not taxable federally, and then a married file jointly, the first 30,000 for 2025. What I understand here from this article, and you can read it yourself, if I'm making a mistake, let me know, the first 30 grand is not taxed federally, on a federal level. I don't know what state levels and municipal levels could vary, but just wanted to point that out. So that kind of explains the ordinary dividends and the qualified dividends, the different tax rates. And now we're going to talk about non-dividend distribution. So I was confused. I wasn't sure. This is in section 1099 DIV, DIV for dividends, right? So it's non-dividend distribution in line number 3. You see here, I received $4,176.36. And I found out, and I noticed that in my 1099 at miscellaneous, you could see here there's substitute payments in lieu of dividends or interest. So it appears to me when I was filing my taxes myself on the tax software that I used, this actually was included as taxable. So it looks like this is taxable, right? But the non-dividend distributions in line 3, that is not. And I actually double checked with different sites. And I found this really good article from H&R Block. They explain non-dividend distributions, and they basically say it's pretty much, that is return of capital. You can see here they also note this, they call it like what are non-taxable distributions. So non-dividend distributions, aka non-taxable distributions. There's a caveat to that because it's until you get return of capital. Once you get return of capital, then it is taxable. So non-taxable distributions are payments that are return of capital. This means that shareholders' original investment is being returned to the shareholder. These payments are not paid from the corporation's earnings and profits. These distributions reduce your basis on the stock of mutual fund and aren't taxed until the investor basis is reduced to zero. So let's say if you have a stock that's worth $100 and all your payments are labeled as return of capital. So until you get the full $100 back, supposedly what this means, and again, I'm not a tax preparer. You need to speak to a tax advisor. Only once you get the full $100 back, from what I understand as a retail investor, novice, is that only then you're going to start paying taxes. Now we're going to go into the 1099B. In the 1099, there's in the consolidated 1099, there's different portions: 1099 INT for interest, 1099 DIV for dividends, 1099 miscellaneous income, 1099B. So 1099B is like your P&L, your profit and loss, and then you have to further separate that, delineate that between short-term and long-term capital losses. What I understand is short-term capital loss is taxed as ordinary income, as you saw the previous tax brackets, and then the long-term capital loss is, I think, almost like qualified dividends, of what I understand. If I'm wrong, let me know. This is just my understanding. Again, not an expert. So here there's something called the wash sale disallowed. So you see here I had a $11,030 loss because I was swing trades and all kinds of trading and day trading, all kinds of craziness shenanigans. And you see here that it's disallowed. It's disallowed. So basically I could have had like $11,030.76 that would have counteracted my profits, and I would have been like probably a net negative on paper, but unfortunately because of the wash sale it was disallowed. So what is the wash sale? So when you have a loss, right, and you want to have the loss as a counted as a write-off on your taxes to have it at least have some silver lining and have a tax benefit, because you could write it off as, a short-term loss that's held less than a year could counteract a short-term gain, and a long-term loss can be considered against a long-term gain. Where do I get this? From IRS.gov. So in IRS.gov, they talk about, here they say short-term or long-term. So you have to correctly arrive at your net capital gain or loss. Gains or losses are classified as long-term or short-term. Short-term. I may want to talk about this in another video, maybe not, but here's the extra thing I wanted to say what I did over here. So I made a recent video about how it almost felt like we were people who were heavy in Bitcoin or Bitcoin correlated assets or Bitcoin correlated high yield dividend assets felt like they were having their own personal recession, myself included, because there was, MSTY was down like 40% month over month at some point. And it was crazy. In the past week, everybody was down who had, Misty or Coney or, all kinds of Bitcoin correlated assets, LFGY. So what did I do? I sold my Misty, right? And not all my Misty, just a portion of my Misty. I brought it down to a certain health, lower percent that I felt more comfortable. And I still wanted to be in the Bitcoin sphere, but I felt too concentrated in this one asset of MST MicroStrategy, and specifically the Yield Max's trading of this MicroStrategy. So I wanted to branch it out a little bit more. So I bought something called BTCI. So this is a product from Neos, and we can go into this in a different video, but they hold 25% of something called HODL. So you're actually kind of buying a portion of Bitcoin and you're kind of DCAing in directly into Bitcoin. And I got some LFGY, which is a whole basket of fun. I would like to say that they're substantially different, similar but different, because Misty is a single stock ETF on MicroStrategy, and BTCI is like basically it's a Bitcoin trust, and it's a little bit different. It's not even based on Misty, MicroStrategy at all. And then LFGY, that's a whole basket and from YieldMax, but they do all kinds of Bitcoin and tech. So it does have MicroStrategy inside, but that's only one piece of it. That's a whole ETF. You know what I mean? So I would think, as a retail investor, that they're still substantially different enough. But who knows? We'll see it. Hopefully the IRS will see that as well. Don't follow me because I don't know if I'm doing it correctly, but this is what I did for now. And I noticed that Bitcoin is coming back up right now because there was an announcement that Donald Trump just made. So Donald Trump made an announcement, as you can see here. The U.S. Crypto Reserve will elevate its critical industry after years of corrupt attacks by the Biden administration, which is why my executive order on digital assets directed the presidential working group to move forward on a crypto strategic reserve that includes XRP. See, he doesn't mention Bitcoin. He mentions crypto, XRP, so I think is that Solana, and ADA, to make sure the U.S. Is the crypto capital of the world. We are making America great again. So, that kind of makes me, in a way, it's interesting. I see a lot of hype. And I've noticed Bitcoin just jumped up like crazy. Holy moly! It's, you know, Bitcoin was, you know, 95,000, and it went all the way down to 78,000, and now it's jumping back. Look at this trend over here, guys. From the announcement, he didn't mention Bitcoin, but he mentioned crypto. Maybe it implied Bitcoin. I don't know how to interpret this, but you see here it's coming back up. But so, you know, let's say Mystic goes back to $30 a share, but at least I was able to do some kind of strategy. You know what I mean? And also, I wasn't comfortable myself having too heavily weighted into one. I wanted to, for my own personal taste. This is my own personal taste. So I get to ride the momentum up in other assets, you know, that are Bitcoin correlated. Anyways, I hope you guys enjoy. Sorry about the rant. Hope you guys have a wonderful weekend. All the best. Be well.